Hey everyone, welcome to the Story Trading weekly meetup. We're now usually doing them on Monday nights or as needed instead of the Sunday nights we used to. But before we get started, we do have a presentation on update on CLFD VIP pick from Chris Tarbert, and we'll do a macro review. But first, Story Trading is not an investment advisor. That goes for all of our guests and speakers. Investing in securities involves significant risk of loss. We're recording this event. It will be made exclusively available to our VIP members throughout the balance of the week, and then we'll get this posted up on social media early next week. So we will first go over to Chris in just a second to do the update on CLFD. Then we'll do a macro review. We got Sanjay and Matt joining us for their perspective on the macro view as well. But first, you can see here, Clearfield. This is a VIP pick. He presented it first to us on April 28th. I know he was talking about it long before then, but we officially started tracking it on April 28th. The stock's up 30% since this presentation, which has really outperformed the rest of the market during that period. And the stock is also up over 100% since the CEO presented to us last summer. And here is the stock chart. You can see where we're at, and we'll go ahead and learn more about CLFD. There's earnings coming up. So we're going to do that through the lens of the four pillars so we can understand the price action behind that chart. So with that, Chris, welcome back. How you doing?
Sure, appreciate it. Thanks, Ben. I'm going to really break this out into four parts. I'm going to do a little bit of intro about myself and Clearfield. Then I'm going to talk about things to look for in the next earnings call. Then I'm going to break out into what I think is going to, what's going to happen next after that. And then I'm going to touch base on really what's driving not only Clearfield, but the sector in regards to all the government grants, whether it be the Rural Development Fund or the BEAD program, but really just the massive tailwinds in the industry. So as Ben said, my name is Chris Tarbert. I've got a background in telecommunications and private equity. I actually had a 3 or 4 year stint at a metro fiber ring builder about 15, 20 years ago. So I've actually been feet on the street, actually building fiber optic networks. So that's sort of how I came about with Clearfield. I've been following the company for a better part of 12 to 14 years. I've met with management and board members on numerous occasions. I've been to the headquarters in Minneapolis. So I like to think I know the company pretty well, especially the management team that has been pretty much rock solid in place for the last, like I said, last decade, last 14 years. I know there's been some discussion on when the Clearfield earnings call is. I have confirmed it is July 28th. Unfortunately, that is the same day that Apple announces, and that's actually a discussion point that I've had with management about, potentially moving that date, not to be overshadowed by Apple. In the last 5 or 10 years, it's been okay to, present on the same day as Apple, as they generally move the market upwards. But, I think a lot of people would expect Apple to have a rough couple quarters here. They started today, I think, in a sense, slowly, putting out some tough news and maybe spoon feeding everybody instead of hitting everybody on July 28th. So maybe that'll help the case. But anyway, obviously too short of a time window for Clearfield to change its date, but maybe in the future we'll see them try to move away from having a date that's so dominated by the biggest company in the world. Anyway, so Clearfield, for those of you who aren't familiar with it, just 30 seconds. They are a manufacturer of fiber products, terminus boxes. They especially in the rural market, tier 2, tier 3. They have spent a lot of money in the last 5 to 10 years to be compliant in a tier 1 market. But for the most part, in the next 3 to 5 years, the opportunity really is in the tier 2, tier 3 market. There's been a lot of discussion about where they are in terms of market penetration. I would put them around 60% and climbing. The CEO last earnings call actually came out and said that they were taking market share in that space. She all but said that looks like one of their biggest competitors may be packing it in and just focusing their business on the tier 1, basically giving up the space to Clearfield. So there's a potential in the next year or two, you could even see them climb to 70, 75, 80% market share. As far as the earnings call, the things that I'm looking for, number one, is the close of the acquisition that was announced a couple of months ago of Nestor Cables, a specialty fiber manufacturer in Finland that's been a Clearfield customer or a Clearfield supplier for the better part of 5 to 8 years. They know the company well. They really like their manufacturing capabilities, et cetera. They may actually even take some of that manufacturing and do some of their own in Mexico. The company does about 33 to 35 million in annual revenue, makes a slight, small profit. I think probably somewhere in the 8 to 10% net margin range, but it is growing at a 20 to 25% clip. So that's something to look forward to. The next is progress on them moving into their new production facility in Mexico. That's going to triple their production capability in Mexico. I think that's a key expansion for them. It will allow them to be able to meet some of these growing backlogs that the company's been experiencing and will likely continue to experience the next 5 to 10 years. I believe their doubling of their facility in Minnesota is done. So the Mexico one is the one that I want to hear that's been completed, and how that's going to accelerate service delivery to their customers. The last is, what's the conversion of the backlog to revenue? Up until about a year ago or even 6 months ago, Clearfield was able to really clear their backlog within a quarter. They prided themselves on being able to do most inventory turns in 2 to 4 weeks. Obviously, with the sort of this hockey stick backlog growth that they're having, they've sort of said that they're clearing backlogs in 6 months instead of 3. So what the commentary I would like to hear is now that if, with Mexico and Minneapolis, now ramped up to handle these new volumes, can they get back to clearing backlogs, in under 3 months? So those are the key things I'm looking for. Obviously, I'm looking to see what kind of growth the backlog has. Are we starting to see even more material orders placed due to bead and RDOF, coming up here in short order? So what's going to happen after that? Well, if you look at any of the 3 analysts that are covering Clearfield, 2 of them have price targets in the mid to high 70s, which Clearfield's already at. Needham, who in my opinion always seems to sort of get the growth trajectory that Clearfield has a price target in the low 90s. Obviously, there's going to be some material model changes when they have to now start including Nestor Cables into their models, and also what is the conversion from the backlog to revenue. Looking at their estimates for this quarter, they're, in my opinion, on the very low end. They're in the high 50 million range. I think at minimum you're going to see Clearfield post a number around 65 million, maybe even 70 million. The company is notorious for being ultra conservative in their guidance, and I think that this is the case here. And you're going to see some significant increases, not only to the models but to price targets. Lastly, Clearfield is presented at Paul Silverstein's analyst shop several times. I think Paul's been sort of watching this company on the sidelines. I wouldn't be surprised if he starts coverage here in the back half of 2002, if not early 2023. My guess is he's waiting for them to sort of reach and hold that $1 billion market cap, which Clearfield's currently pretty much right at. So if they can hold that billion market cap for say 3 to 6 months, wouldn't be surprised to see Paul Silverstein and maybe some other analysts start to cover the company. Next, in terms of RDOF and BEAD, we've been starting to see some of the awards go out. They've been very favorable to Clearfield and the fiber community in general. It looks like early numbers are that 80 to 85% of the grants that have been awarded are fiber specific or last mile specific, which is right in Clearfield's wheelhouse. Clearfield gets anywhere from $50 to $200 for every home that's connected. So back of the envelope sort of numbers, if we see an award of about 100 million, and it's directed at a Clearfield customer that's doing a fiber build, then my expectation, and a couple of buddies of mine who've done some number crunching, looks like you're probably talking about 7 to maybe 10% of that amount would fall right to Clearfield. Not to say that all these government grants for RDOF and BEAD are the only revenue drivers for Clearfield. There's still 5G deployment. There's still tier 1 opportunities. There's still international, et cetera. But obviously, all of the focus has been on this 80 to 85 billion that's targeted here in the next 5 to 7 years, right at the tier 2, tier 3 rural fiber deployment. So the commentary from, I think, Sherry and the CFO on where that's at, they've alluded that in the last couple of quarters that they've actually started to see some orders come in. They've been working with their customers on planning 6 to 12 to 18 months ahead. So you might see some eye-popping numbers hit that backlog as customers want to make sure that they have the equipment that they need. One point that I wanted to make that's really important is that a lot of these government grants have requirements to them in terms of install, meeting deadlines, et cetera. So it's incumbent on Clearfield customers not only to have the equipment, but to have the labor to be able to install this. That's where Clearfield sort of has been gaining market share, as they've touted their product line and their solution set to be labor light or labor friendly. And they've done a bunch of sort of test modeling or beta test, if you want to call it, with some pretty large tier 2 customers that have proven out the case that not only is Clearfield solutions 20 to 25% cheaper than their competitors, but also 20 to 25% easier to install. So you can install it with less people and less trained people, for lack of a better word. So a simpler labor set to be able to install. So if Clearfield's got the manufacturing capacity up to 100%, they can meet their customer requirements, who are meeting the government's requirements to do these projects within the timeframes that are required by the grants. So a key sort of information point to realize that when the government hands out this money, that they have certain expectations that the money is going to be spent not only correctly but on time. Other than the sort of the conversations I've had about potentially not only getting another analyst on board, moving the earnings date so it doesn't coincide with Apple, but also is there the possibility, if the stock gets in the triple digits, which I certainly expect it will, would they entertain a stock split? Because one of the knocks that I've sort of heard is that the Clearfield float, as some of you may have noticed, that when you try to buy the stock, it's an extremely tight float. So I don't know if that's scaring off institutions. I know it does for some, but that's one thing that I sort of put a bug in their ear. So as Ben has said, the stock's been moving up nicely here in the last month or so. I think when people take a hard look at sort of the multiples that Clearfield trading at, it's at a pretty conservative number in the mid 20s. After this earnings call, you may see that it may drop down to a PE of 2021 for a company that's doing 80% revenue top line growth, earnings growth, and in my opinion will only continue to do so. They've got a $135 million backlog. Wouldn't be surprised to see at least the 50 to 60% of that is recognized this quarter. But again, that all depends on how well they're doing on the expansion into the new Mexico facility. So with that, Ben, I don't know if you have any questions or if we want to take some questions from the field, but that's sort of my prep.
That was amazing. Yeah, every time I talk to you, I get more and more impressed with your depth of knowledge with this company here. And I didn't even know, the connections he had with management. That's great. I came into this thinking, wow, this is a stock that's outperformed. It's up 30%. When is it time to take some profits or sell covered calls? And now I'm thinking maybe I don't have a big enough position.
Well, I mean, look, the thing is, and to be honest with you, and we talked about this, I think, in the last couple calls we had about Clearfield. Clearfield was in the low 80s, sort of high 70s. And if you remember correctly, there was sort of that 2-bit analyst shop out of Los
That's right.
Angeles that put out a nasty short report on it, timed it with some broad market weakness, and just knocked the stock down 15 to 20 bucks in 2 days, right? So tight, real tight float, as I mentioned before. So, the company, sort of in my opinion, and you can sort of look at the timing of this, if you noticed, made some changes to the stock buyback plan, I think, which gave him some flexibility to, I sort of not have a stopgap for some shenanigans like this, but I think that was probably their intent. And it was amazing because literally after a week or two of this ridiculous short report, Clearfield came out with earnings that were just through the roof, and the analyst threw his hands up and went running away. So maybe he made his money, realized he was, the company was going to continue to deliver in the future, and just hightailed it out of there. But obviously, with the fact that the analysts only covered their company for less than 2 to 3 weeks, it's kind of pretty easy to tell what his MO was, right? So that person's gone. The company, if you want to bring the chart back up, you can see when it happened, sort of in that February timeframe, and it's the chart's just been, sort of a march since then, with continued earnings that have, been in my estimation really impressive. I don't know how many companies out there in this environment, have 80%. Continue to have 80% growth rates, and with such a macro tailwind at their back. Now, when obviously there's ETFs that hold the stock, and if there's a broader market shakeout, is it going to get hit? Yeah, it's going to get hit, a little bit. But with management owning such a large block of the stock, you can look at this. The chairman of the board has never sold a share. He continues to buy over the last 10 years. I think he owns close to 11% of the holding of the stock right now. I don't know. It's tough in this environment for me to find a company that's got all the gears working for it right now.
Yeah, it's certainly outperforming. Has a lot of relative strength. I have noticed it does get hit on market down days. It hasn't really bucked the trend on those specific market down days. So those could be buying opportunities. But yeah, what I really like about this is that it's recession resistant, if not recession proof, I would think, almost in terms of their business they're getting. I'm not so sure. I don't know if do you have any insight into their margins, or if inflation can hit their profit margins? Do you know anything about that? With commodity prices or input?
Their net margins have been increasing significantly. You may see a little softening this quarter as they ingest Nestor cables, which obviously wasn't running the same net margins as they were. And as they you see them again ingest this new facility that they're going in Mexico, and the doubling of their size in Minneapolis. But again, I mean, look, this is a Midwest company with Midwest management. And I say that because they've been really conservative in the last 10 years. And for them to take these aggressive steps in the last 9 to 12 months, I think speaks volumes on what they think is coming, especially in this environment. They would not make these investments if they didn't know that, their sector, which again, I think they have about a 70 to 75% market share, was just going to see a tsunami of revenue coming in from their customers.
Hmm.
And
Fascinating.
I think you're starting to see that in their backlog numbers, which are, I mean, their backlog's up 600% year over year. And if, you know, unless something, you know, just really traumatic happens to these government grants, you know, you're talking 80 billion coming into the sector in the next 3 to 5 years. And again, that doesn't even include the, you know, 5G small cell build out. So with that said, again, I think if you know, if you look at the analyst numbers, they're shockingly low. I think that give them, I'll put it out here right now, and I wrote about this in the Bazinga article. I think they easily do $4 of earnings next year in 2023, if not 450 to 5. So now, with that said, what would be the bear case? I would say, well, the bear case would be this is not a software company. It's not a company that's going to do, you know, 60, 70, 80% margins. A lot of people will say, well, it's just the, you know, twisted plastic fiber company. You know, there's no maintenance that you get on the product or whatever. It's just you're selling plastic boxes. Yes, they're specialty boxes. And, you know, it's a cycle that eventually is going to end. Okay, well, I can't argue with some of those points, but I would counter to say that once they land a customer, they almost never lose them, right? If they truly have a 70 to 75% market share in that tier 2, tier 3 market, no one's going to come in and take it away from them. Now, the argument would be is, well, how long is this cycle going to really last? Okay, well, they've come out and said they think it's going to be 5 to 10 years. Okay, that's just the sort of the fiber build out. Again, you've got 5G small cell, you've got international. You know, I think they're going to start to break into the tier 1 market when the tier 1s finally realize how much money and time that they can save using their solutions. So I think you've got a fair amount of runway here. Again, in a recessionary environment, like you said, and with the tailwinds that they have, I just think it represents a great opportunity.
Awesome. Just for perspective, I'm curious if you don't mind disclosing, is this your largest position?
It is. It is. I don't look. You and I have had sort of discussions, especially in the last 6 months, how to trade this market. I don't have many long positions. I generally like to trade options on a weekly basis in case, you know, the market gets a lot worse. So I sell a lot of puts in companies that I don't mind owning in case I get caught. But I generally, in the last 6 months, other than a few long positions, and it's less than 5, and this is certainly one of them. And I do set, you know, with Clearfield, you can only do monthly options. Now, from a trading perspective, I'll sell options at 50, 45, $40 just in case, you know, something squirrely happens. But if I get caught and those shares are put to me, I'm happy. So I've got my long position. I've also got, you know, I sell puts against it.
Awesome. Yeah, that's something I've been doing more and more of, is selling volatility, because this market is so choppy with those ups and downs. It seems to be the only way to make money is to sell volatility, unless you're long Clearfield. That's the other way to make money.
Yeah, I mean, look, and you see, I mean, you see the other sort of stocks that I look at or that I'm selling short-term puts on. Costco's one. Maybe we'll talk about a little later that, you know, KMPH Chem Farm, you know, that stock's just gotten crushed in the last year or two. But, you know, it looks like they may be breaking out. So, you know, again, to your point, and you know, until the Fed pivots the other way, you know, Friday at 4 o'clock East Coast time, you know, I'm praying for that time. So all those options, you know, that those puts that I sold, they've expired, you know, for me, and then I get to collect that nice premium.
Yeah, I love that. All right. So yeah, maybe we'll come back to KMPH at the end, make a couple comments on that. You know, what would be great is if you can at some point create just a few bullets for us on what to expect in that conference call. You had a few really nice comments on some qualitative things you were looking for, right? Not just the dollars and cents with the revenue and profit for the quarter, but there were some qualitative things you're looking for. That'd be great. Awesome.
Yeah, I'll put them. You want me to put them in the VIP trading board?
Yeah, put somewhere in there, and we'll keep track of it so we have it before July 28th. That'll be awesome.
All right, sounds good.
All right. So with that, let's do a quick Q&A, but I'm going to pause the recording. So this Q&A will be just for VIP members, not going to be recorded. So everyone can feel comfortable to chat about Clearfield with Chris. Let's see if there's any questions. Just a moment. All right, great. Thank you, Chris, for that awesome presentation. If you are not a Story Trading member yet, you can join us and collaborate in the CLFD research room. We also have many other groups where we can collaborate on CLFD and other stocks. We'll come back to Chris maybe at the end for an overtime off the record session on KMPH if there's time. First, we're going to do a quick macro review. Got a couple of our collaborators here, contributors, Matt and Sanjay, who I've invited to give their view on macro. First, I'm going to go through a couple slides of my own here. You guys can feel free to jump in if you'd like anytime or save your comments and additional commentary for the end. But as far as the macro, when we talk about macro, we're really talking about the impact on the major indices, right? What's the impact on the major indices that can potentially then have an impact on some of our particular microcaps, risk assets, whatever they are. And the factors we're looking at CPI, inflation, how that impacts interest rates, how that may impact the dollar strength, whether that's good or bad, that dollar strength. We're looking at commodity prices. We're looking at consumer demand. These are all the market moving items coming in every single day, intraday, throughout the day. Today, earnings season really kicked off. Well, this week, I think Goldman Sachs was earlier this morning, but really the big ones, the tech ones people are waiting for. Netflix tomorrow, Tesla later this week, and then Apple, the big one, July 28th, which is going to be key. And the other thing I've been looking at is a 200-week moving average on the technical. So just a few things I want to show you guys. First of all, this morning, Goldman Sachs, prior to the market, even though they beat earnings and the stock was up, they did say they plan to slow hiring and bring back annual performance reviews. And then in the around midday today, when the market turned, right, the whole reason the market was up this morning, then it crashed. When did it crash? When Bloomberg came out with a report that said Apple is going to slow hiring and spending for some of their teams next year. So you can see how sensitive the market is to anything which may indicate a slowing economy or a recession. Another point I want to bring up is the strong dollar. This is very interesting. We've seen so quickly how a strong dollar can impact commodity prices, which is a benefit. You know, also there's benefits in terms of importing. Exporting, though, takes a hit. And any companies that have multinational operations and they sell overseas, that's a hit for them. So let's just read this one together. This came out tonight after the market closed. It says analysts, even though they beat, so IBM beat, I believe, both on the top and bottom line, but there was some guidance in terms of revenue that was being impacted by the strong dollar. So it says analysts were concerned about the effect of the strengthening dollar on IBM's financials heading into the print, and the company seemed to confirm some issues there. Chief Financial Officer James Kavanaugh told Reuters ahead of Monday afternoon's conference call that foreign exchange rates would hurt second half revenue more than previously expected. And then as we go down, well, let's read this quote. With a significant movement of the US dollar as compared to nearly every other currency at mid-July spot rates, currency translation will not be about a 6-point headwind to revenue growth for the year. It will not be, let's keep reading. Kavanaugh said on the call after previously guiding for a headwind of 3% to 4%. That's a degradation of about $1.5 billion. But going further, at current spot rates, currency translation has increased to about an 8-point headwind to revenue growth, impacting a reported revenue, profit, and cash, he said, of the current quarter, while adding that the launch of a new mainframe product in the second quarter will lead to a sharper. Okay, so there you have it. So you can see how any kind of news on a strong dollar really has a real impact. It's a complicated impact when it comes to the strength of the dollar. There's positives and negatives to it. Another thing that I wanted to point out, this is from, well, it was reported on Daily Mail, but this is actually a CNBC survey, right? This CNBC survey is talking about 61% of people are driving less, 4 in 10 people are spending less on groceries. So there's a real impact happening here. So my point in bringing all this up is that we're not necessarily out of the woods. This is a chart that I brought up many times, an old chart. The price is an update. I'll show you the updated chart in just a second. But I've been talking about the importance of the 200-week moving average and how this technical line is a reflection of a fundamental reality. And as long as we're above that 200-week moving average, in my view, we're still in a bull market, right? I know the technical definition of bull and bear market, we're in a bear market. I get it, down 20%, but we were up so much that in my view, I just see this as a correction and a reversion to the mean, and just, taking out some of that froth of the COVID excess. And to me, that's what we've seen so far. We've seen us coming back towards that 200-week moving average. And the question to me is, if there's a real fundamental issue, such as anything more than a mild recession, a long recession is stagflation, that's when you can go below the 200-week moving average and stay there. Historically, once you're below it, you're there for an extended period of time, a matter of quarters. The only exception was COVID, which was like a false move below it. I don't want to say false, but we had that massive liquidity that reversed it. So that's a pretty good sign. Only 3 cases below the 200-week moving average, and they were all very, very significant events: dot-com bust, financial crisis, and COVID. So that's what I'm looking at, and you can see that we did get closer to that 200-week moving average. What were we? 391 when I made this chart. So we're down here at 383. So what's going to happen, right? Earnings season is upon us. Apple's reporting July 28th. Are we going to stay above the 350? Is Apple, going to send us below 350? To me, that's where we're at. I don't necessarily know the answer. So with that, I'm going to pause and see if Sanjay or Matt want to chime in. Sanjay, I see your mic's already unmuted. So go ahead with your thoughts, Sanjay.
So, Ben, as far as the market is concerned, my biggest concern is FOMC. I'm reading more and more articles. Well, actually, let me step back. It seems over the last couple of weeks, market has been rallying, and there is certain expectation getting built up that the Fed pivot is not too far. Some people think Fed may raise 75 basis points next week, and then at least the pace of rises may go down. So the next raise in September may be just 25 basis points or even 0. It's entirely possible Fed takes a pause. My concern is that, on the other hand, I'm hearing that Powell is probably so concerned about inflation expectations getting built into consumer behavior that unless he does something, unless the Fed does something dramatic, or unless the Fed really breaks something, they won't slow down the pace of increases. In their view, a recession is better than a sustained inflation. So that's my biggest concern. And I think given the behavior of the market over the last couple of weeks, I think it's just, it seems market is a bit more relaxed about the inflation and interest rate. They're not taking Powell's threat very, very seriously. And that's the reason over the last couple of weeks, if you look at, bank earnings or some of the earnings that came before, Micron is a very good example. Even the earnings were very bad. The guidance was very bad. The stock is still rallied after the announcements. So we're already in a bad news is good news market, because some investors think that some of those, all of this bad news has been embedded into the prices at current levels. And I'm concerned that's not the case. And the second point I would make is, and that's very, very important, this is about gas supplies from Russia to Germany. So they have a pipeline called Nord Stream 1. It currently is in a maintenance window, and the window ends on this Thursday, July 22nd. It's entirely possible that Putin does not turn on the gas again, right? So if that he does not turn on, if he does not supply the gas to Germany, it will cripple Germany's economy. Germany makes a lot of, the industry is dominated by heavy stuff, heavy equipment, fertilizer, steel, aluminum. And if the gas does not come, they may have to ration actually the gas, not only to consumers, but also to industry. And that cannot be bad for European economy, German economy overall. So these two are my biggest concerns, I would say, over the next 1 or 2 weeks.
Can you reiterate what is that catalyst, Jill, about the natural gas?
Okay, so basically Germany gets natural gas from Russia, and there are mainly two gas pipelines. One of the pipeline is called Nord Stream 1. Currently, it's on its annual maintenance. So basically, they shut down the pipeline, for a week to perform the regular maintenance. So right now, it is shut down, and it's supposed to come back up on July 22nd. And there is fear that Putin may not actually turn on
I got it. Okay.
gas. And if that happens, it will cripple
Wow.
Germany's economy.
Wow, that would also cause UNG to skyrocket. Actually, I was on a Wolf Spaces panel tonight, and one of the panelists chose UNG as their trade of the week.
Wow.
Yeah, I don't know if it's related to that cattle. I think they're just looking at technicals, to be honest with you. I'm just
right. So I would also say if that happens, I think in the companies in US that produce fertilizers, so steel or aluminum, I think they may also benefit because there'll be less supplies from the German companies. So that could be another play, right? Go after the same producers, but in other countries. And I think we are better positioned because we have plenty of natural gas.
Well, that's just Friday, July 22nd, this Friday.
This Thursday, yeah.
This Thursday. It's called the Nord Stream 1 pipeline.
That's correct.
So Nord Stream 1 pipeline running from Russia to Germany. Does it go through any other countries or serve any other countries?
So this one, I think, does not. The other one does come through Ukraine, but Nord Stream, my understanding is a direct pipeline from Russia, underwater, undersea.
Wow. Well, okay. That's great that you put that on our radar. That could put a lot of potential stocks on our watch list here. Chris says, I think Germany is planning to restart 10 coal-fired plants. Not sure how long that would take. Yeah. Coal's been going up too. BTU and Arch. And shut down 3 nuclear plants by year. Okay. All right. Got a lot of nuclear exposure. All right. So, Matt, did you want to jump in and add any additional comments?
Yeah, I'll just, I guess, say from a big picture, I still see that very much as a bear market. I think the moves week to week we're seeing, a lot of it is sentiment based and based on the news flow. So when we have some positive expectations, you're seeing prices move up. I think that you've got to look to fade those moves and vice versa. When it's very pessimistic and the news flow is very negative, again, you've got to look to fade that and trade those moves as well. So I don't think this is going to change for the rest of the year, but who knows? We're going to be in this choppy kind of market. Resolving inflation and the Fed's moves, I think there's a lot to play out here. I think it takes time.
Yeah, I agree.
So yeah, I mean, some of my favorite plays are key in on like the gas outlook in Europe through Vermilion, VET, and coal plays. I quite like those just for stocks that are able to do better in an environment like this, but they have risks with them too.
Yeah, I mean, they tend to go down, at least sentiment wise, they tend to go down with recession data, recession
Correct.
Fears as well.
Yeah. So I mean, they have some particular catalysts, or in the case of gold, very strong cash flows that you've got visibility sort of the next year. But yeah, nothing sort of without risk at the moment. So I really like things that have a particular catalyst or a particular angle to them. otherwise you're trading the market like everyone else, and that's tough, really tough.
Yeah, yeah, it is. It is. It's basically, like you said, it's got to be like a special situation to outperform. Otherwise, any kind of stock picking you're doing, you're really just basically trying to time the market. So do you think that you said you're still bearish. Do you think the bottom is not in for like a QQQ or SPY?
Oh, so I'm pretty clear in my head. For me, I think we're still in a bear market. So it's not that I'm bearish right now. I actually think we're going to see more of a relief rally right now. But yeah, long term, I think we haven't had Q2 earnings yet. We're going to see some disappointments through that. But even if we see the indices, grind higher, I think that's for a year, personally. There's got to be more to come. The Fed's got more tightening to do.
Yeah,
They've got quantitative tightening coming, which has only really just started. Any pivot they do is a long way away in my mind.
So just thinking out loud here, I mean, the question I think is this priced in? Because, when this all first started between like November and recently, I think there was a whole lot of denial, right? No one was really thinking about recession. Everyone was saying inflation's transitory, right? There was a whole lot of denial, or some people just didn't see it. Now, everything you just mentioned, is that already baked in? Is that already known? Because everyone's talking about we're going to have a bad earnings season, and everybody's talking about Apple's under pressure. Like, so how do you gauge that? Maybe all this is baked in.
Yeah, so you could, and that's quite it's a good way to look at it, Ben. The reaction to earnings announcements, stock by stock, to tell you what the in terms of where we're at. So if you have a bad result and the stock doesn't sell off, or a good result and it sells off, that tells you two completely different things. And it tells you about the sentiment in the market as opposed to necessarily the individual stocks.
Yeah, and
so I think
perhaps
that's a really interesting way to look at it.
It's good you brought that up, because perhaps a warning sign. I brought up IBM earlier. IBM, they beat, right? They beat on earnings, but they had the warning about the currency impact, giving them an 8% headwind on revenue. So the stock was down significantly in after hours, from 138 to like 132, and 132 there would represent not a new low, but it's right at the 200-day moving average. So quickly went right to the 200-day moving average. So that could be an ominous sign potentially if Apple announces something bad next Tuesday.
Yeah, I mean, Apple's signal today around hiring, the stock's only off 2%. Nothing. That means nothing.
Yeah.
That stock could fall significantly in a tougher consumer market.
Absolutely.
As we've talked about a number of times.
Yeah, we've been
I think the indices,
the
indices are driven by those big companies,
right,
and they're not immune to consumer impacts, with rising costs and rising interest rates impacting much all assets. It's a headwind environment.
Yeah, and Apple, as we've talked about before, Vince couldn't make it tonight, but him and I have been on the same page, thinking technically Apple can go to the 100 to 112 area. We're pretty much on the same page exactly on the technical outlook there. And Apple's at 147 now. So move to like 100 to 112 obviously won't be good for the market. We got a comment from Chris. It looks like Apple will spoon feed bad news to soften the blow. Speaking of that Bloomberg article that came out, interesting. I think someone at Apple leaked that to the media. That is what happened. I want to ask you, Matt, about Zim, because Zim's a stock you had put on my radar when the war broke out. I think I had heard of it before, but you had a particular thesis of why the situation out there with the war was good for Zim at the time. So it's been on my radar. Obviously, it took a big hit recently because of recession fears. What do you think about it here? Because we saw a technical break here above the 20 DMA. in Zim today, and it hasn't been above the 20 DMA in a good while. What are your thoughts on that one?
Yeah, the thing with Zim, just to realize, and why it's a bit more volatile than some of the other container shipping stocks, is it has a lot of short-term contracts. So it has basically baked in for this year incredible earnings, which will earn its market cap based on current price. You know, from your perspective, there's kind of a floor, I think, to Zim in terms of price. They've also undertaken to return a lot of those earnings as dividends, you know.
Yeah.
So that's the positive story. The negative story for them is it's an uncertain environment next year. If you're in recession and container shipping drops significantly, which you'd expect it to, very bad for Zim, as opposed to some other container shipping stocks which have longer contracts that span many years. An example of that would be Global Ship Lease, ESL. So I've actually traded out of Zim earlier in the year, and I have some exposure to shipping via GSL, which is underwater at the moment because it's had a terrible, everything's had a shocking last sort of month. That at least has longer term contracts, so that's sort of how
GSL was also up significantly today. Was the whole shipping sector up today?
I think the whole sector was up. Because it's just been sold so heavily. Now, shipping, the bit I like about shipping and the war is it's kind of like a hedge, because supply chains still seem to be really broken. And on top of that, there's contract negotiations going on with the unions in American ports, with railway workers in US and in the UK and various countries. So there's all these kind of frictions that can happen. And it doesn't take much for the system to get bogged down. And my understanding from the periphery is the backlog of shipping basically still exists into the US. It's just moved away from Long Beach to other ports. You've obviously had Shanghai locking down for over a month recently. There's risks going forward that Shanghai might lock down again. And to me, you know, that's a positive for shipping companies that have long-term lease contracts, because the backlog kind of just sits there and it creates distortion in the market for pricing. The big negative for, you know, most shipping stocks is a recessionary environment. So, you know, you've sort of got to take quite counteracting forces at the moment. And I think the market, you know, while these stocks might look cheap based on earnings, the market's saying, we see a recession, we're just going to sell them anyway.
Yeah. All right. Well, good to have your feedback on that. I appreciate it. So definitely recession risk, you're validating that's still there. And with the case of Zim, they have short-term contracts, not long-term contracts, which could make them a little more vulnerable in a recession situation next year.
Yeah, in saying that, it's trading very similar to the companies with longer-term leases. So I think you just have to think of it as trading sardine as opposed to long-term hold. That's probably the only thing I'd kind of add to it. You can't think of these stocks necessarily to hold forever.
Well, we'll see
what happens. You're going to get very attractive dividends. You're going to get amazing dividends. So don't play it with options.
Well, we'll see. These technical breakouts have not worked. It's all chop. Everything's a false breakout in every sector, every stock usually. So we'll see if it works this time. I sold cover calls right away this time. I'm learning my lesson about the chop. So we'll see what happens if I can get a win out of that somehow. So appreciate your comments on that.
The only bit I'd add to that big picture macro is on the US dollar, like you were saying, and the very high US dollar is incredibly bad for other countries, particularly fuel importers. Most of Asia, Europe, obviously, is facing extreme pressure, having to import, energy sources at both high rates, but plus with a currency that's weaker relative to US dollars. So, this has played out a number of times before. And when you have high energy costs and a high US dollar, it's just terrible, the world economy. So this is almost a self-fulfilling, process that's going to force some bad stuff to happen.
But
and
that's
sort of
really
part of the
really
overlay.
good for, isn't that really good for US consumers? We can get products cheap out of China.
Yeah, you can, but you gotta look at it the counteracting side. So if it's bad for the rest of the world economy, then those consumers have less money to spend. They're spending it on basics like fuel and imported goods at higher prices. So it's not just about the US consumer.
Yeah, it's
So
complicated.
that's the thing. It's complicated, but there's a very good piece by Lynn Alden recently, just looking at this, or even just Google US dollar wrecking ball. People have talked about this kind of issue in more detail, more experience.
Good for US consumers, but I guess Chris and Sanjay, I'm looking at the chats there. Good for US consumers, bad for US exporters. But what's that net out to in terms of stock valuations, right? Because yeah, I get it that the top line for multinationals will be impacted, but if good for US consumers also means higher consumer spending, right? Doesn't it? You're getting more stuff, you're buying more stuff, everything's cheap, right? You're selling more domestically. So I don't know net what the impact is going to be to the stock market.
Well, Ben, you just highlighted a couple of things in your presentation. People are spending more money on food and energy. So that means even the US consumers have less money to spend on discretionary items. Now think about Europeans and Asians.
Yeah.
They're paying everything in US dollars because
Right.
a lot of things, energy and less wheat and corn, they're priced in US dollars. So they're paying even more in local currencies. So they have even less money for discretionary items.
Yeah.
So who's going to buy Apple iPhones?
Yeah, I know. I was just thinking, as soon as he said that, I'm thinking Apple is screwed, man.
Yeah. I'm surprised Apple hasn't warned. A lot more companies should have warned. Even IBM is announcing it today. Microsoft is the only major multinational that announced a month ago that they'll be hurt because of a strong dollar. But nobody else has done it. Nike and even companies like Google and everybody. They're going to bring less revenue and profits in US dollar terms from overseas this year.
Right. You guys are thinking, you're trying to convince me that we're going to drop below that 200-week moving average here. I don't know. Making some good points. Yeah, we're going to research this. I think it's maybe offline. Look for some historical articles, historical precedents for what happens when the US dollar is really strong. There's a YouTube link Matt's put in the chat now. But in any case, it's getting
watch.
Yeah, it's getting late. If you want to hang on, if Chris is still there, we'll talk KMPH for just a minute. But as far as our recording goes over here, guys, you can follow us on YouTube and StoryTrading, YouTube and Twitter at StoryTrading. Also, we're on Spotify. You go to storytrading.com/Spotify to catch all our recordings. And with that, we're going to stop our recording. Thank you, everyone, for joining us.